The Indian rupee has been making headlines for its consistent depreciation against the US dollar and other major global currencies. This is not just an economic statistic, it's a reflection of deeper structural, policy driven, and global forces at play. Today, let's dissect this phenomenon with a comprehensive perspective connecting historical trends, current dynamics, and what the future holds for the rupee. As you all may be aware, today the rupee is hovering at about 86.65 at this point of time when we are talking over this discussion. To understand where the rupee stands today, we must look back. The rupee has seen a long term trend of depreciation since independence. In 1947, 1 rupee was equivalent to $1. However, this parity quickly eroded as India's economic framework leaned on protectionism, higher imports, and limited export capabilities. By 1991, during the balance of payment crisis, the rupee was officially devalued to 17.90 vis-a-vis the dollar, ushering in a new phase of economic liberalization. The following decades saw the rupee gradually weaken due to a trade deficit and the growing dominance of the dollar in the global trade. Between 2000 and 2014, the rupee's value moved from almost 44.94 to 61 against the dollar, highlighting the currency's vulnerability to global financial crises such as the dot-com bust and the 2008 financial meltdown. Let's look into the reasons for which the currencies depreciate. Currency depreciation is not inherently bad. It depends on whether it is controlled or disorderly. Depreciation can boost exports by making goods cheaper globally. However, for a country like India, heavily reliant on imports for oil and gold, a weaker rupee inflates import costs, widens the trade deficit, and stokes the inflation. This delicate balance is where the rupee often struggles. But why does the rupee depreciate? Broadly, three forces drive this. One, trade deficit, persistent imports exceeding exports. Two, inflation. Higher inflation erodes the currency's purchasing power. Three, capital flows. Foreign investment flows into the countries offering higher returns. When this flow reverses, currencies also depreciate. Now, let's look at the 2014-2023 phase, the new challenges in a globalized world that India has faced during this period. Let's focus on the rupee post 2014 when the Modi government took charge. The rupee stood at 61 against the dollar. There was optimism about economic reforms, foreign direct investment, and stable oil prices. The rupee saw stability until 2018, trading between 66 and 67. However, from 2018 onward, cracks began to show because of trade wars. US China trade tensions led to a global uncertainty and oil price volatility. India's reliance on imported oil made it highly sensitive to price changes. Then, rising US interest rates, the Federal Reserve's tightening cycle strengthened the dollar, weakening the rupee. By 2022, the rupee hit a historic low of 83. This wasn't surprising given the backdrop of the COVID-19 pandemic, high global inflation, and geographical conflicts such as the Russia Ukraine war. And then, why has the rupee fallen so sharply in recent months? In the past 6 months, The rupee has faced unique challenges. They are: one, US Federal Reserve policy. The US has aggressively raised interest rates to curb inflation, making the dollar more attractive for investors. This flight to safety drained capital from emerging markets like India. Second, oil prices. Despite efforts to diversify energy sources, crude oil remains a significant component of India's import bill. OPEC's production cuts have kept prices elevated, widening India's current account deficit (CAD). Third, geographical uncertainty. Events like Israel Hamas conflict and Russia Ukraine war have increased global risk aversion, boosting the dollar as a safe haven. Fourth, weak exports. India's exports, particularly in IT services, have slowed due to reduced global demand, further pressuring the rupee. Now, we need to question ourselves: is the rupee's fall a global or India specific trend at this point of time? Many of us wonder if the rupee's fall is unique to India. The truth lies somewhere in between. Globally, most currencies have depreciated against the US dollar. Even the euro and Japanese yen have lost value. However, the rupee's depreciation has been sharper than some of its peers. Now, at this point of time, we may pose a question: why rupee has steeply depreciated? The reasons for that are trade imbalances. India consistently is running a trade deficit, while countries like China maintain trade surpluses. Export competitiveness. India's export growth has lagged behind nations with robust manufacturing bases. Structural dependence on imports. A significant share of India's imports, like oil, electronics, and gold, is non negotiable. This makes the rupee particularly vulnerable to global shocks. So, what is there for us to learn from global currencies? Looking globally, some countries have managed currency stability better. For example, China. China leveraged a trade surplus and capital controls to manage the yuan's value. Japan. Japan uses monetary policy aggressively to control the yen. Switzerland. As a safe haven currency, the Swiss franc remains strong despite global turmoil. India, however, does not have these luxuries. Its trade deficit, reliance on external capital, and high energy imports limits its options. So what can we do to stabilize the rupee? The path to a stronger rupee lies in addressing structural issues such as export diversification, boosting sectors like manufacturing and services to reduce reliance on IT exports, and energy independence. India has to accelerate investments in renewable energy to reduce oil import dependency, and we need to attract long term capital. We need to have policies to attract stable foreign direct investment rather than the volatile portfolio flows. And then we need to have monetary and fiscal prudence. Keeping inflation under control and managing fiscal deficits effectively is what the need of the hour. And in the broader context, when we look at it, is depreciation always bad? The answer is, it's important to note that a controlled depreciation is not necessarily a cause for panic. For exporters, a weaker rupee enhances competitiveness. For the economy, it can reduce imports and correct trade imbalances. The challenge lies in managing the pace and scale of depreciation without triggering inflation or investor concerns. In conclusion, the rupee's fall is a part of broader global and domestic story. It reflects both India's economic vulnerabilities and global monetary dynamics. The road ahead demands structural reforms, prudent policies, and a focus on long term growth. The rupee's journey is a mirror to India's economic health, and while challenges exist, opportunities are also abound. The key lies in leveraging the challenges to build a more resilient economy. What do you think? Will the rupee rise to meet the challenge, or will it require a deeper economic shift? Whatever be the views you may have, you may share them through your comments in the comment box. Hope the information is useful to you all. Thank you very much for your patient hearing.